Hey, welcome back everyone. It is time for another red hot covered call video. Well, hey, look, today we're going to talk about 3M. We're going to talk about how I used the poor man's covered call and then how we took the profits from that and we're going to buy a monthly dividend paying ETF. I'm going to show you that ETF here in a moment, but let's talk about 3M and where it's been recently. And I'll tell you what, its recent earnings provided an absolute perfect opportunity to get involved with 3M. And instead of buying the shares, I went ahead and used the poor man's covered call. We're able to buy a Leaps call option on the cheap, and then we wrote a near-term covered call. I'm going to explain all of this. But hey, look, before we get going, if you like anything you hear, I want you to subscribe to the channel. It's right there and it's free. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now, what I'm doing is I'm talking about two investment strategies. We're talking about selling premium. That's where we typically own shares, and we're going to give somebody the right, but not the obligation, to take our shares away from us at a price I pick. I give them a certain amount of time, which I pick, and they're going to pay me a per share premium. That is going to be the profit for which we then buy a monthly dividend paying ETF or closed-end fund. And that is our true, absolute passive income. Because when we take the covered call profits and buy that monthly paying dividend stock, it's going to pay every single month. It is our dividend money tree. This is how I think, and this is my mindset. This is why you need to subscribe to this channel, because this is what I talk about. I'm going to show you my trade. We talk about it, so maybe you learn something. And of course, gear your trades that best represent your risk tolerance and how much money you have. In this case, we are using $12,000 for this trade. Now, if you don't have $12,000, you don't have to go out and buy 5 Leaps call options on 3M. You can buy 1, 2, 3, whatever your bankroll permits. And what I'll tell you is this: you want to be diversified. Don't go out and just spend all your money on this trade, because it can go south really quick. I need you to trade smart. I definitely want you to have the mindset that we are going to sell premium and then buy monthly dividend paying stocks. So we're generating the cash flow needed to have that money tree, that dividend money tree. It allows us to think about early retirement, having retirement income, paying the bills, living the good life. Now let's go ahead and get this started. All of my members get all this information. Go to cptdashboard.com, click Upgraded Dashboard. I give you 1 free month to see the world through my eyes. Well, all my members see all of the trades, including the one I'm about to show you now. So go to cptdashboard.com, click Upgraded Dashboard, get your 1 free month offer. Would love to welcome you aboard. You know, I've been doing that membership now since 2019. A lot of people absolutely love the energy I bring and all of the trade ideas. And of course, you have all those videos that I do for the members that you don't see here on YouTube. In fact, I'm going to do a video for them on all of the various dividend stocks that I buy to generate monthly passive income. So if you want to be a part of that, just go to the website, get your 1 free month offer. So right now we're talking about 3M and where it has been and where it's at now. 3M has recently had earnings and it absolutely got rocked. And I love using a great stock like 3M when it has a tremendous down day. And as you can see, that's exactly what it did after earnings. It actually beats earnings, but the forward guidance is horrible. And they sell this sucker off from 110 all the way down to 94X. And that's where I got involved with 3M when I decided to buy a Leaps call option instead of the shares. And once I bought that Leaps call option, I went ahead and wrote a near-term covered call. I'm going to outline exactly the Leaps call option I purchased, why I did, and the covered call I did sell. It's within the poor man's covered call tracker that you can do this, because my initial trade setup for this has me buying the 96 Delta Leap, which means if a stock moves $1, this Leaps call option that I'm about to show you moves 96% of that $1 move. Now that's brilliant, because if the stock starts to move higher, I capture all of that movement with my Leaps call option. So that's what I decided to do. We're going to buy the July 19th, 2024 expiration. We're going to buy that 70 Leap, right? That 70 strike, meaning I could buy somebody's shares at 70. We paid $25.30 for that. That represents a mere 0.64% in time value cost. See, the time value is the true cost of this trade. It's not the $25.30. It's the time value portion of the option price of $25.30. And that turns out to be about 61 cents per share. Now, in this case, it's a Leaps call option, so I don't have shares. But it's 61 cents per share that I'm paying. So, with that said, notice that the 61 cents is my cost. So, my first covered call should pay for that. And in this case, it does. Because the very first covered call I write is going to be for the 96 strike because the stock's trading for 94.69. So I pick the 96 strike, it pays $1.47. So if my shares are taken away, and we're going to talk about that here in a minute because I don't own shares, this will be a 10.7% cash on cash gain or $1,358 on $12,000 invested. Now the premium alone, if my shares are not taken away, meaning 3M does not trade above 96, and this trade expires worthless, meaning they don't take my shares, I keep my shares and I keep the premium, this will generate a 5.8% or $735 profit in 30 days. And those are the kind of trades we want to do with the poor man's covered call. If I'm not making 5 to 8% on my very first trade, I'm not going to do the trade. So with that setup, that's how we start this trade. I buy the Leaps call option, which is a 96 delta. I'm going to buy the 70 strike, meaning I could take somebody's shares away from them at 70 in case I need to produce shares. Remember, we are simulating stock ownership here. I don't own the shares. I'm just buying the right, but not the obligation to buy somebody's shares at 70. I'm paying $25.30 for that right. Turns out there's a lot of intrinsic value in that option because there's only 61 cents of that $25.30 being the time value portion, or the cost of the trade, or the money the covered call writer made when I paid them $25.30. Now, with that paper in hand, the $70 Leaps call option paper in hand, I can write a near-term covered call, as if I own the shares. And that's what I did. With the stock trading at 95.69, I decided to write the 36 strike. Notice when the stock's trading at 94.26, we're going to go to the charts. I'm going to show you the charts again just so you get a bigger picture of this. When the stock's trading at 94.26, I sell the 96 strike. I will give somebody my shares at 96. They paid me $1.47 for that right. So up front in premium alone, we are making $735. Now you say, John, where's that $1,365 you were talking about? Well, of course, that's where our Leaps call option comes in. The Leaps call option supports this entire trade. See, I can't do this trade without having the paper to buy somebody's shares at 70. Because that means if the stock were to rocket higher, I'd be uncovered, and that means I would have to go to the open stock market and buy the shares to give the shares to this person at 96. We don't want to do that. We have up to 6 months to use this paper, this Leaps call option, to write monthly covered calls, making more cash on cash percentage gain with every single trade. Because think about it. I invested $12,600. If I'm able to make $735 for the next 6 months, do the math. When we eventually cash out of the trade, hopefully profitable, think about that cash on cash percentage gain compared to if I owned the shares at 94.26 where I could have bought them. Okay, so I hope you're kind of understanding the poor man's covered call strategy versus buying the shares and then writing a standard covered call. What we're doing is we're buying the right to take somebody's shares at 70. I paid a little bit in time value cost, but now I'm going to write the near-term covered call as if I own the shares. With that said, if the stock rockets past $96, I'm okay. Because remember, I could buy this cat's shares at 70. That's the beauty of the poor man's covered call. I don't have to spend that much capital up front. Because remember, I buy 1,000 shares, that's $94,260. In this case, taking control of 1,000 shares, that would only be around $24,000 to $25,000. Okay, so you understand the capital requirements here. I don't have to have as much by using the poor man's covered call. Now, in this case, I only did 5 contracts. I invested $12,650. So now the trade is placed and somebody took my offer and that $735 gets deposited into my account. Now, where does the other money come? Now, remember, when I bought this option, the 70 strike, it had a 96 Delta Leap. So when I paid $25.30 for it, that started the trade, right? That started the trade. The stock was trading at $94.26. Now, if the stock moves higher to 96, well, the Leap's call option is going to move higher, and it's going to move 96% of that move. So that's where the difference is from $735 in premium alone, this number right here, to the $1,365. Because when we plug in the number for the potential projected Leap's call option price, well, that's going to be $26.56 per share on 500 shares. That's going to be an additional $630. So we're going to make $735 on the covered call, and in theory, we're going to make $630 when we sell our Leap's call option. Now, with that said, there's slippage, there's a little bit of a delta issue here because the stock moves 1 for 1, and mine's going to move 96% of that, and if there's a short sale and my shares are assigned and I didn't close this trade out, we may not make $1,365. I've outlined this in many of my videos. You have to understand your Leap's call option delta, because otherwise you could find yourself not keeping up with a 1-for-1 move because your Leap's call option will move based on its delta. In this case, it would be 96 cents to a $1 move. So I'm not getting much slippage there. And that's going to be beautiful because when my shares are taken away at 96, I'm basically going to knock down the entire $1,365. Let's go to the charts real quick and take a look at this bad boy, because there's a reason I got involved with 3M, and you could see it has everything to do with that earnings fall. Now, 3M has been trading in a range that I like. And notice, every time it trades at the bottom part of the Keltner channel, by the way, the Keltner channel is a stocks trading range. Every time it trades at the bottom, it finds itself to the mid, sometimes higher. And that's what I like here. As it's falling, it rises to the mid and moves higher. Look, 3M is a legacy stock, man. It has hundreds of products on the shelves that you go out and buy stuff every day. So at the end of the day, they're one of those companies that's going to be around probably much longer than you and me. So Wall Street will come back to them when they sell off because they have a fat dividend. And they never give up on a dividend. I mean, they could have gave up on that dividend years ago when the stock fell from 250 all the way down to 90x. But they will defend that dividend and fall on their sword. I'll tell you, I have seen 3M fall from 250 to 95, and they haven't changed the dividend. So with that said, of course, I don't have a crystal ball, but with that said, I'm going to go ahead and trade it. And I love the range being about $90 to $95 because that's where I want to get involved, because that's where it has tested support and moved higher. And that's what you notice here. As it falls, moves higher, it falls back to support and moves higher. And it would not surprise me if 3M actually finds itself back at support and hopefully moves higher. But at the point that we lose all of that money on the day that they had earnings, well, that's when I want to get involved. I waited about 2 days just because I wanted the stock to actually fall a little bit, kind of settle at its final price being $94, and then we got involved. And that's where I used a Leap's call option to simulate stock ownership. If our shares are taken away, we're going to generate some $1,365. Now, if they're not taken away, of course, we're going to write covered calls, and hopefully we can get out of this trade profitable, meaning 3M does not fall further. And also remember, this is not stock ownership. I only have until July 2024 to make this trade profitable. And the way I make this trade profitable is 3M to find itself around 94x, because then my Leap's call option will be trading around the purchase price I paid. That's the key here. We want it to trade around the price that we entered. So that's the goal here, and that's what I'm trying to do. So with that said, let's talk about the monthly dividend paying ETF that I'm going to buy with all of this money. Now, this is where we create passive income. You heard the semi-passive income strategy where I write a covered call on some shares or Leap's options I own. We generate that premium, but now we're going to put that premium into a passive income stock. Because what I wanted to do is now generate income month over month over month, and that's what we're going to do. So we're using a Yield Max ETF. Yield Max has a lot of criticism, because YieldMax has created these ETFs that essentially use an underlying stock. But see, they don't actually buy any shares. They simulate stock ownership with calls and puts, and what they do is they sell calls and puts against that position, and they generate massive amounts of monthly dividends. Ones that would actually scare you if you're a traditional closed-end fund investor, where you usually try to go out and get 7, 8, 9 cents per share to generate your monthly income. You're happy if you can find one that pays 20 cents. These stocks will pay some 56 cents a share. The PayPal version of this is PYPY, and it follows PayPal. And the reason I'm picking this one is because as PayPal moves, so does PYPY. Now, it's not going to move identically to PayPal because, of course, PYPY has restrictions. They're writing calls against their simulated stock ownership. So if PayPal rallies 100%, well, PYPY is not. Okay, so we understand this. And of course, you have calls and puts, so they're going to make money on the upside and the downside. Well, the reason I like PYPY, because it follows PayPal, and PayPal is trading in such a range where I believe the bottom is in on PayPal. So if I'm buying PYPY and they're paying some 56 cents a share with PayPal trading at the bottom of its range, well, that's good, because what we're hoping is that as PayPal moves sideways to higher, PYPY will move higher as well. But this is what we want to do. We want to take all those covered call profits, and where we can, we put them into dividend-paying stocks. This one is the one I use for this moment. See, what I do is this. If I make a $500 crumb on a covered call, or a $400 crumb on a cash secure put, or maybe I hit the mother load and make $1,200 on a trade, or $2,100 on a trade, I immediately drop down and I buy equivalent amounts of shares of PYPY. I'll buy Tesla, which is the Tesla version, the Coiny, which is the Coinbase version of the YieldMax ETF. Now, I also have a lot of closed-end funds too that pay anywhere from 9 cents a share to 20 cents a share. And those are your more traditional ones, where companies like Eaton, Columbus, BlackRock, they'll basically create these closed-end funds that generate near-term cash flow for their investors. And to be honest with you, all they care about is generating the near-term cash flow for the investors. They don't care if the stock goes up or down. For the most part, they always stay trading sideways. I mean, I've been involved in EOS for years, and EOS has basically just traded sideways, haven't made a nickel on the shares, but have generated so much dividend, it actually paid for the share price. So right now I'm playing with house money using EOS, and EOS is pocketing about $500 a month into the account doing nothing. And here's the deal. You could actually drip invest that, where what you do is you have your brokerage just buy equivalent amounts of shares in the money they pay you monthly. So then you're building up shares, which means you're building up more monthly income. Now, I'm in retirement. I'm 55, and I retired from the 9 to 5 in 2022. So what I do is I use that money. So I have all these monthly dividend payers depositing money into the bank account, and we use it. We use it to pay the bills, live the good life. But for you, you can use it as a drip. And hey, look, if you got grandkids or children and you want to create these kind of monthly dividend investment strategies where you're building real wealth using passive income, what you want to do is learn the selling premium strategy. Once you hone your skills and you really learn how to sell premium against shares you own, then you take those covered call profits and buy these monthly dividend ETFs and closed-end funds. And now you're realizing real wealth. You have found your financial freedom. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.